Hi, I'm Pete Andresen with Andresen & Associates, and I'm here to talk about small stocks. This is my video for September 12th, 2024. But first, before we get into small stocks, let's talk a little bit about what's happening with the economy, because inflation numbers came in today. As you've been watching in the last couple of weeks, the stock markets have been bouncing up and down because we're not sure if we're really going to have that soft landing or not. At this point, with the economic activity slowing down, especially in manufacturing, in a normal economic cycle, and this, believe it or not, is a relatively normal economic cycle, what happens is the unemployment rises, manufacturing cuts back, and you can't tell the difference between a soft landing and a recession. So everybody's in a frenzy over AI. Everybody's in a frenzy over the tech, large cap tech. Everybody's running around trying to figure out what's going on, so they tend to move with some volatility. Now, this is normal. It is also normal for overvaluations to occur, and right now the S&P 500 is overvalued. We cannot say this could go on for years or it could end already. We don't know. As we look at the slowing economy, soft landing looks just like a recession at this point, and we won't know until we're in it. We're looking for alternative investments. Our treasury investments, buying those longer maturity, longer duration treasuries, is going to pay off at this point, probably, because as interest rates decline, there'll be capital gains in those longer term bonds. So we have been holding those things for about 2 years. Makes me choke just to think about it. It has taken a lot longer than expected, and the same may be true of any market outcome or market changes. But despite what the yapping heads on the television or the media are saying, this is relatively normal. We are at an all-time debt level that has yet to shake out. We have no idea what that wrinkle is going to look like. But going deeply into debt during times of low interest rates, again, is normal. So with that in mind, let's look at small stocks. Please take a look at this graph. It's been a boom decade. Think about what we've overcome. We've overcome COVID. We've overcome political dissonance. We've overcome so many things. And yet, when you look at this, the red line is the S&P 500. If you invested in the S&P 500 in a decade, you turned $10,000 into $33,000. So pat yourself on the back. The uncertainty about how long this is going to keep going forward is why I'm not currently rebalancing out of these, even though they're overvalued. The yellow line is small stocks. Small stocks have historically, in the long term, overperformed. They've outperformed the S&P 500. In other words, small caps, because they're small corporations, they're the dog food maker, the hot tub maker, the people who make petroleum distribution facilities, the fabric of our economy. They can grow faster and change faster during economic maturation, shall we say. But this decade they haven't. Why is that? 2 reasons. Number one, the fear of a recession. If you look at 2020 there, the yellow line goes down more than the red line went down. Fear of a recession and uncertainty. The second reason is that people tend to buy what everybody's buying, and the result is that they all have flocked into AI, and they've made the FANG stocks or the Magnificent Seven or whatever you want to call them heroic. Now, Vanguard long-term treasury. Treasuries have muddled by. $10,000 became $1,100 if you reinvested. But wait, there's more. Check out this graph about what happened to valuations. Again, this is kind of normal. In market cycles, people go to extremes, just like they tend to go to extremes in political cycles. And if you look at the upper right corner, that's large cap growth, and that's overvalued somewhat according to Morningstar. This is in March, and it hasn't changed much. It's overvalued because everybody's piling in, because AI is the neatest, most wonderful thing. On the opposite end of the spectrum, if you go diagonally down to your left, you see small value stocks. Small value stocks are undervalued in this graph, 22.7%. Historically, they've seldom been cheaper. Again, fear of recession and the fact that they're relatively unloved because they don't have AI in the heading. So small stocks are historically cheaper. I might add, just take a little rise up, you'll see that mid-cap and even large cap value stocks, that's the cement makers, the auto manufacturers, the basic fabric of the economy is undervalued as well. This is very reminiscent, I might add, of the late 1990s, although not as extreme. But wait, it gets better. Take a look at this astonishing graph. This is really remarkable. This is a 23-year graph. It's 23 years because that's when Vanguard introduced their long-term treasury investment. That investment turned $10,000 into $29,000. So 23 years, $10,000 becomes $29,000. Very, very decent. Very taxable too, which is why this should be in your IRA. The red line represents the S&P 500. That's the SPY. That's interesting because in 23 years, $10,000 became $64,000. So pat yourself on the back. It's astonishing. Now think about what has happened since February of 2001. We've had 9/11, we've had wars, we've had chaos, political turmoil, and COVID. Astonishing. Pat yourself on the back. Now, the yellow line represents the DFA US Small Cap Value Index Fund. Just the index fund, $10,000 became $90,000. $90,000. Small cap historically has done this multiple times through history. Small cap outperforms large cap over the long term. Again, because they can grow faster when they're discovered and they can adapt to changing economic situations. But look at that big downturn in 2020. That's your giveaway. They get pounded in recessions. That's why people haven't piled in. That's why we haven't piled in. Now, check out this graph. This is large versus small cap cycles. Yes, Virginia, it's true. Small cap trades places with large cap as time goes on. Now, 2001 to 2014 were one of the most dismal times for the S&P 500 ever. And 2000 to 2010 were one of the worst represented. That was one of the worst decades for the S&P 500. It was actually negative for the decade. So it can happen. The S&P 500 can go negative for 10 years. But look what happened. Small caps actually outperformed substantially because they came from a place of being undervalued, just like the late 1990s, where they were undervalued in favor of technology. They came roaring back and had just a bumper decade. So small and large cap investments trade places in the first place, and they both actually do okay. So, again, why aren't we in more small caps? The answer is we're not sure about that recession out there. It would not surprise me if a recession happens after we start a soft landing. On the other hand, I really can't say, and nobody can say, if a soft landing followed by a soft landing will take place. We're at all-time highs in terms of debt, so I don't know where we go from here, but it's certainly not looking dire, and historically this is relatively normal. One last graph. Okay, check this out. This is since 2015. You can see small stocks delivered a total return of 120%, let's call it. Large cap delivered 237%. So we're not rebalancing out of our S&P. We're expecting to see some capital gains in that big bond holding we've got. And we'll be okay if we buy small caps. Thank you very much. We live in wild times, but the world rolls on. So that's what you can expect to see in your portfolio. Please call me with any questions. Enjoy the fall, and blessings.